Let's dive right into one of the absolute most fascinating paradoxes in the AI infrastructure space right now. We're looking at Western Digital. Back in August of 2026, they reported what can really only be described as a historic, record-breaking quarter. But the market's reaction? Honestly, it was completely wild. $3.75 billion. That was Western Digital's revenue for the fourth quarter of fiscal 2026. And the context around that top-line revenue number makes it even more impressive, because it's up a staggering 44% year over year. They generated just an incredible surge of cash.
But that brings us to the central financial mystery of today's explainer. How exactly does a company report its best quarter ever and then immediately lose 16% of its total value? Over just 2 trading sessions, the stock completely crashed. Why did investors so severely punish a company that literally just delivered one of the strongest financial quarters in its entire history?
To figure this out, let's start with Section 1, a historic financial quarter. In their August 5th press release, CEO Irving Tan was absolutely glowing. He stated that, quote, revenue increased 44% year over year, gross and operating margins expanded, and earnings per share more than doubled. These results show a level of operational excellence that frankly left analysts stunned, especially as the company aggressively scaled up to support booming global storage demands.
The blockbuster metrics build incredibly fast here. Revenue hit that $3.75 billion mark. Gross margins jumped over 1,300 basis points to a record 54.4%. Operating margin reached 44.2%, and non-GAAP earnings per share came in at $3.56, which is up 109% year over year. Because of this massive quarter, across the full fiscal year 2026, the company swung to a staggering net profit of $9.42 billion.
So where is all that money actually coming from? Well, Western Digital is really no longer a diversified storage company. The cloud segment now completely dominates their business. It represents about 90% of total revenue, bringing in $3.7 billion in Q4 alone. The major cloud providers are quite literally buying everything Western Digital can physically make.
Which brings us to Section 2, Anatomy of a Crash. If the numbers are this phenomenal and the cloud is buying up everything, what went wrong? Well, as Barron's perfectly captured in their sentiment right after the report, an earnings beat just isn't enough these days. Shares plummeted 16% across 2 sessions because Wall Street basically panicked over 3 specific clues hidden in the report: disappointing shipment growth, lower forward guidance compared to their main rival Seagate, and sky-high market expectations heading into the release.
Let's dig into that first clue. Exabyte shipments, which is the actual volume of storage capacity sold, grew only 22% year over year. That completely missed expectations. However, total dollar per terabyte pricing rose in the high teens. Translating these dense financial metrics into plain English, Western Digital is making much more money per unit because they raise prices, but they're selling fewer actual units than analysts wanted to see.
Then we have the final 2 clues. Western Digital forecast a very strong gross margin of 55 to 56% for the current quarter, but their rival Seagate had implied guidance of over 57%. You know, when your closest competitor projects slightly better margins, investors instantly take notice. Combine that unfavorable comparison with the reality that Western Digital's stock had nearly tripled since January of 2026, creating almost impossible expectations, and boom, you have a massive sell-off.
But there's a bigger picture here. Let's move to Section 3, AI's compounding storage loop.
We really need to widen our lens well beyond the immediate short-term headlines to examine the underlying AI demand engine. CFO Chris Senesail described what he calls a compounding loop for AI storage demand. The logic breaks down like this. First, training. We need massive storage to refine large language models. Second, inferencing. This is where the outputs, intermediate data, and reasoning of those models must be stored. And third, physical AI, which is early-stage growth from robots, autonomous driving, and large-scale video capture. It's a continuous loop. Training creates better models, inferencing generates infinite outputs, and that stored data feeds right back into further training. And because of this compounding loop, the timeline of demand is aggressively accelerating. In just a short window, their projected exabyte compounding annual growth rate shifted significantly. Back in February 2025, they expected mid-teens growth. By February 2026, it was 25%. Now, by August 2026, they're projecting greater than 25%, with executives noting long-term projections are potentially, quote, starting with a 3. The demand curve is pointing sharply up.
All of this creates a severe supply shock. A recent note from Morgan Stanley highlighted that AI-driven demand is growing at 40 to 50% annually, while supply is trailing far behind at just 30 to 35%. As a result, hard disk drive supply is projected to be 10 to 15% below demand in 2026. Because of this, hyperscalers have fully booked Western Digital's entire capacity through 2026, and their long-term customer agreements now stretch all the way out to 2031.
Let's look at how the company is structured for this in Section 4, the SanDisk separation.
To understand Western Digital's unique position today, we have to look back at the February 2025 spinoff. Prior to 2025, they also owned SanDisk, but they separated, creating a stark contrast in their post-spinoff identities. Western Digital is now a pure-play HDD company, perfectly positioned to capture the massive archive and capacity layer of AI storage. The pro here is their intense singular focus. The con, of course, is concentrated customer risk. Meanwhile, SanDisk became an independent entity focused entirely on high-margin flash memory and AI edge computing. The sheer size of this AI storage ecosystem is just staggering. SanDisk, their former flash memory arm, recently outlined a massive $93.9 billion customer backlog, and they're targeting 80% margins through 2030. There is simply an incredible amount of money flowing into every single corner of AI storage. Which brings us to our final section, Section 5, a story of scarcity.
This brings us to the core takeaway for today's explainer. It's time to completely shift the paradigm of how we evaluate Western Digital going forward. Let's revisit a crucial insight from a Bank of America analyst note. They wrote, quote, "Pricing, not shipments, carried the quarter." Remember, Wall Street initially panicked over lower unit shipments, but Bank of America looked at this exact dynamic and maintained a buy rating, setting a $720 price target based on 19 times projected 2028 earnings. That multiple is above the historical range because they recognize a fundamental structural shift in the business model.
So the absolutely crucial point here is this concept of scarcity-driven growth. Western Digital is no longer a volume story tied merely to how many new data centers are being constructed. They're successfully expanding revenue and margins by commanding much higher prices on limited, highly demanded capacity. It's fundamentally a scarcity story driven directly by the insatiable, compounding data demands of AI. Which leaves us with this final provocative question to tie the whole paradox together. Considering the historic profits, the aggressively accelerating AI compounding loop, and the fact that capacity is literally sold out through 2026, is the market's 16% punishment just a short-term warning sign of unrealistic expectations? Or is this the ultimate buying opportunity in the foundational infrastructure of AI? Thanks so much for joining me on this explainer.